please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Aashish Somaiyaa is Managing Director and CEO at Motilal Oswal AMC. He's joining us right now. Aashish, good morning. Great to have you here. Is the flow of, are the inflows still as strong as they'd been? I mean, in January, December, months before that? I'm talking about Feb.
Yeah. So December obviously was a record, and January number has to be seen a bit in detail, because we showed January as 16,000 crores net flow as far as equity mutual funds are concerned. But the unique thing about January, before I come to Feb, the unique thing about January was that the gross inflow, because this number consists of inflows as well as redemptions, and that's how we arrive at the net number. So January was pretty high, more than 50,000 crore of gross inflow, but I think the uncertainty related to tax resulted in some redemptions, because people started hearing about the implementation of long-term capital gains tax, but there was uncertainty on how it would get implemented. So between 15th January to 31st January, the industry saw kind of redemptions, and despite excellent inflows, it's the redemptions which played spoil sport, and January ended at about 16,000 crores. Now obviously, as far as February is concerned, my estimate is around 18 to 20,000 crore net flow. We don't have the numbers yet, but it was maybe as good as what January was. February was not as high, because December was 28,000 crore net flow, which was more like a record. So what we are seeing is that the inflows continue to be as strong as they were. January, it was the redemptions which played spoiled sport. February, the data is not yet out, but my sense is we will be better than January.
Okay. So Aashish, just going into the next fiscal, what is your sense in terms of the kind of flow picture we're working with? Because there will be technicalities such as CLT, CG, which will be out of the way. So in that sense, redemptions as well as flows?
So, I think that redemption bit was one-off in January. That's why I kind of went into details of explaining what caused the blip in January. My whole intention was to point out that it was a one-off. Maybe, December 28,000 crore net flow was also an outlier, because our annual average is right now more between 22,000 crore kind of number. So I don't expect a significant let-up, or I don't see anything on the horizon which will cause people to hold back significantly. In fact, usually what we see is that when there is a correction which kind of prevails, I mean, this was too short and sharp. Suddenly we just saw in the first 3-4 days of February, we saw a significant decline, and then the market has kind of stabilized in a particular range. Typically, when there are sharp corrections, the first reaction we see is for people to put in a lot of money, because even as we speak, there is money on the sidelines, and people have made good returns in the last couple of years. Plus, at the same time, it's not like other alternative asset classes are really looking too great. It's not like there has been a huge bump up as far as interest rates or fixed income funds are concerned. It's not even like there is huge money which is going into, say, real estate or gold. So I don't see anything which would create a kind of let-up as far as flows are concerned. So our picture remains buoyant like it has been so far.
Mm-hmm. But you would agree, Aashish, this is the first, I mean, I hate to use the word sustained, but it's kind of this you said sharp and swift, but it's not as if it's seeing a big V-shaped recovery as well, right? I mean, it's lingering, festering. That sometimes is more of a problem than a sharp, swift cut and then a sharp recovery.
So what, as a fund management company, honestly, I am not really complaining about this particular decline, because let me put another perspective, that last year was very difficult for most of us. Because if you see 2017, it was no fun, because the index itself, if you see mid-cap free float, the mid-cap 100 index, the whole index went up 40%. And when the whole index goes up 40% with everything which is deep value, contrarian, cyclical, just flying through the roof, then as a manager you don't end up looking really smart. So once in a while corrections are good. It's not like it's impacting the performance in a very bad way. In fact, if I speak about us, it's only helping us to pull back some alpha when the market is a bit more discerning in terms of what's working and what's not working. So I'm not very worried if there is kind of festering as far as the index is concerned, doesn't do too well. At least I think as long as marketing is discerning, we will be able to make some money.
In terms of sectors, what is your opinion right now? What are you liking and what are you not liking?
See, we are, if you really ask me, from our perspective, the budget was in line with what we really thought, what you would expect of a typical, last budget before the election. And unfortunately, so many things happened after 1st February that there was no discussion on what the budget can, result in. So we were always batting for, this kind of huge money to be spent as far as, trying to win an election is concerned. So, this whole spray and pray approach which has been played out. So there's money being sprayed in multiple sectors, and which I think is all related to rural growth and consumption. So a lot of our investments, a good part of our portfolios are in this discretionary and staple kind of play. The second obviously is in auto, and if you see the sales numbers and the traction, whether it is commercial vehicles or whether it is passenger vehicles, you're already seeing it. The other sectors which we've always been gung-ho as far as overweight as far as private sector banks, NBFCs and insurance companies are concerned. So that's been largely the lay of the land. We were never so exposed to either public sector banks or to the deep cyclicals or to the metals in a very big way. So not much change as far as our portfolio strategy is concerned. Only thing obviously we are seeing is that there is a bit of rotation in the market, and that's working in favor.
Right. Aashish, this, the SEBI rules which were proposed, right, in terms of categorization of mutual funds, etc., that has got a hard stop. I mean, it has to be done before the 31st of March?
No, so actually it's a one-on-one kind of process. I mean, every asset manager, obviously the lay of the land is clear, the rules are well defined. Now what you need to do as an asset manager is you need to go back to the drawing board and review all your schemes and portfolios, and you need to go back to the regulator with a set of proposals telling them that, how does the regulation impact and what are the changes you propose to make in each of your portfolios. Are you going to merge some schemes? Are you going to change the investment universe for some of the schemes? So all of us have to go back with a set of proposals, and to the best of my understanding, each and every AMC is right now involved in a kind of dialogue with the regulator. Of course, it's not like an open-ended process. I mean, there is a particular timeline, and yes, you're right. I expect that before the year ends, everybody is expected to get approvals from the regulator for their individual set of proposals. So if I speak for myself, for example, this is public information. If I speak for myself, our approvals have already are in place, and we put certain addendums in the newspapers and in the media which talk about what changes we are making. So similarly, for all fund houses, we have to wait for them to come out with the changes that they are making, and I expect that before this year ends, everybody would have got their approvals.
And do you expect now that there's clarity, etc., big changes at an industry level?
Yeah, so clearly what I'm saying is not something very, very new, but two changes I expect. I mean, see, one is that if you see the large cap space, so if your fund is in the large cap category, then that clearly gets pretty much straitjacketed, because the regulation says that you need more than 80% of your portfolio in stock number 1 to 100 by market cap. So that makes a large cap fund pretty disciplined and straightforward, and plus, with total return benchmarking, I believe that it is going to make things a bit difficult as far as pure large cap funds are concerned. But if you see the rest of the space, for example, mid caps, I mean, there have been reports out there which say that mid cap funds are generally underinvested because they need to be 65% between 101 to 250, and funds are generally underinvested in that space because they've kind of sprayed the investment across, because previously there was no such definition. So I do agree with that kind of report, because I have myself seen that in certain spaces the funds are underinvested. It's a reality if you see the data. And once their approvals comes in place, then they have to put a notice of 30 days. And then after that they can start making changes to their investment universe. So it's not even that, just because the regulator has made an announcement, you start making changes in your fund. There is a process of approval. So I do expect that over the next 2-3 months, at least these segment of funds will have to realign. So large cap and mid cap is what is impacted. Other than that, where there are multi-cap funds and, the industry doesn't have too much by way of small cap, and multi-cap funds or other segments of funds are not impacted at all. It's the large cap and the mid cap that's the space one needs to watch out for.
Yeah, Aashish, we're going to let you go on that note. Thanks very much for joining in and speaking with us.